Hey guys, it is Julie here with TipRanks. In today's video, we're taking a look at 3 stocks that score a perfect 10 out of 10. So let's get into it. Alright guys, welcome back and thank you so much for being here. Like I said, we're taking a look at 3 stocks that score a perfect 10. Now that is on the TipRanks Smart Score, which ranks stocks based on 8 different factors and gives them an overall score on their likelihood to outperform the market. All 3 of today's stocks also come in with a strong buy consensus from analysts. So we're going to take a closer look at these companies, what it is that they do, and what these analysts are predicting for their stock's future over this next year. Just before we get into all of that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. All right, let's get right into it. The first 10 out of 10 stock that we're taking a look at today is Synchrony Financial. They trade under the ticker SYF and are currently priced at about $46 per share. The stock also pays a dividend with a yield of 1.96%. That 10 out of 10 rating on the TipRanks Smart Score includes positive technicals and fundamentals, as well as bullish news and blogger opinions. Synchrony Financial is the parent company of Synchrony Bank, and they provide credit, savings, and other consumer banking services. They're headquartered in Connecticut and operate wholly online. They are FDIC insured and have over $62 billion in deposits, $139 billion in finance sales, and $68.5 million active customer accounts. They have 89 years of history and over 16,500 employees. Earlier this month, Synchrony announced that it had renewed the consumer financing program it runs in partnership with TJX Companies, the parent company of TJ Maxx department stores. The renewal makes Synchrony the exclusive provider of TJX's rewards program. In a bigger move, they also partnered with Amazon on the Amazon.com store card and Prime store cards. Year over year, they've seen a 58% increase in new accounts and a 33% increase in purchase volume per account. Looking at the financial highlights, they showed a net earnings of $1.2 billion. This works out to $2.12 per share, which was up by 22% from the previous quarter and a huge increase of the 6 cents earning per share in the year-ago quarter. The company also returned $521 million in capital during the quarter. Their year-to-date total is $849 million, with $593 million in share repurchases. With their latest second quarter results, their profits did come in well ahead of expectations, but their net interest income was below forecasts. One analyst weighing in on the stock following these results was James Fotheringham from BMO Capital. He says that following the recent miss, they lower their estimates by up to 6%, lower than previously modeled net interest income, and higher operating and RSA costs more than offset lower expected provisions. Disappointing loan growth is offset by strong spending trends. However, we do not expect the spend-lend correlation to reestablish itself until savings rates normalize. Our new price target still implies over 20% total return. We anticipate that they will deploy meaningful excess capital worth 20% of total market value to grow earnings per share via accretive acquisitions and share repurchases. James is one of 17 analysts that have a current rating on the stock. And overall, it comes in as a strong buy, based on 14 buy ratings and 3 holds. The average price target of $55.50 would be over 20% upside from current prices. Taking a look at our detailed list of analyst forecasts, on the low end we do have a hold rating from UBS, which would be a 6.5% upside, and on the high end a $63 price target from Barclays, which would be a growth potential of nearly 37%. The second stock on our list today, we move to gold, with Kinross Gold Corporation. Trading under the ticker KGC, they're currently priced at $6.05 per share. The company also pays a dividend with a current yield of 1.87%. Their 10 out of 10 outperform rating on the TipRanks Smart Score comes with positive technicals and fundamentals, bullish blogger and news sentiment, and very positive TipRanks investor sentiment. Kinross is a $7.7 billion gold mining company based out of Toronto, Canada. The company operates in US, Russia, West Africa, and Brazil. They have approximately 30 million ounces in proven and probably gold reserves, and this year saw first quarter gold production of over 558,000 ounces. The company has an excellent operating track record as they have met or exceeded annual guidance for production, cost, and capital expenditures for 9 consecutive years. For ESG, their performance has consistently ranked in the top quartile of their peer group, and the company is committed to reaching net zero greenhouse gas emissions by 2050. They're expecting production growth of 20% from 2021 to 2023. There are 3 drivers behind this, including their recent capital reinvestment phase, continuous improvement programs, and their exploration strategy. In their first quarter, Kinross dodged 2 bullets that could have seriously impeded their operations. First, the Round Mountain open pit mine in Nevada showed instability of the northern wall. It was a dangerous situation that delayed some planned mining operations, but has been resolved. And second, in June, a fire stopped production at the Tasiast mine and mill in Mauritania. The company has worked with local officials to control the situation and put a timeline on renewed production. Taking a look at their most recent quarterly earnings results, their lowest top line typically comes in Q1 and rises in revenues throughout Q4. Their most recent report was for the first quarter and fit this pattern perfectly. The $989 million reported was down from their Q4's $1.23 billion, but was up a noticeable 5.5% year over year. The gains come in part from an increase in realized gold price, which was up 13% year over year. Their second quarter earnings report is expected on July 28th. Covering the stock for Credit Suisse is analyst Fahad Tariq. He recently upgraded the shares from neutral to outperform, saying that while we appreciate that year to date the company has faced 2 major operational hurdles, we think the impact is mainly limited to 2021, with 2022 and 23 still looking like strong production years. There could also be upside from a potentially earlier restart of the Tasiast mill versus the current year-end timeline. In 2022, we expect the company to offset Round Mountain's lost Phase W ounces with other ore sources and expect higher grade ounces to be pulled forward at Tasiast. We also see the stock being supported by buybacks, which could be accelerated in the near term. Fahad is one of 10 analysts that have a current rating on the Kinross Gold stock. And the stock comes in as a strong buy based on 8 buy ratings and 2 holds. The average price target of $9.52 would mean an upside potential of over 56% for this next year. Our lowest price target is a hold rating from CIBC at $7 per share, which would still be a 10% upside, and on the high end, a $12 price target from BMO Capital, which would be a growth potential of 89%. And last but certainly not least on our list today is Eastman Chemicals. They trade under the ticker EMN and are currently priced at about $108 per share. Once again, this company pays a dividend with a yield of 2.58%. Their 10 out of 10 SMART score comes with positive technicals and fundamentals and bullish blogger and news sentiment. Started back in 1920, Eastman used to be a subsidiary of Kodak. Now the company focuses on materials production. Eastman's products aren't everyday household names that you would recognize, but they are found in your everyday life. In building and construction, their window films help make buildings and homes more energy efficient, their additives help make opaque paint more durable, and adhesives and plasticizers improve carpeting, vinyl flooring, sealants, caulks, duct tape, and more. In retail, they help make consumer electronics, LCD displays, and other products perform better. They make appliances, beverageware, and dinnerware more durable and appealing, and food suppliers worldwide rely on them for antioxidants and beverage weighting agents, as well as several food-grade chemicals. You'll also find them in the medical market, as their polymers are trusted ingredients in medical devices and medical packaging that demand clarity, toughness, chemical resistance, and sterilization stability. And even in transportation, as they're involved in aerospace, automotive, aviation, marine, and turbo oil industries. Now, the list goes on and on with other industries and applications that they're involved in. I think you get the point that they have their hand in a lot. Now, let's take a look at some of their recent quarterly results. In their first quarter of 2021, they had record free cash flow of $125 million and are on track for their free cash flow to approach $1.1 billion for fiscal 2021. They're also expecting to repurchase $350 million worth of shares in the year. After a revenue dip in the second quarter of last year, the company's top line has posted 3 quarters in a row of sequential gains. Their revenue came in at $2.4 billion, about 3% above the consensus and up 7.5% year over year. Their earnings per share of $1.99 was up more than 5% year over year. Covering the stock for Wolfe Research is Josh Silverstein. He writes that we believe the outlook for Eastman coming out of the downturn continues to have upside. Driving our view is broad end market exposure with more room for recovery, with less cyclicality than peers, and opportunity for continued pricing upside that can push sequential EBITDA growth to beat prior peak levels. Josh is among 13 analysts that currently have a rating on the Eastman stock. And once again, we have a strong buy based on 10 buy ratings and 3 holds. The average price target of $138 would be an upside potential of nearly 28%. On the low end, we do have a hold rating from a few months ago, which would be an upside of 8%. Most of the recent ratings are all coming in around that 30 to 35% upside, and on the high end, we do have Josh from Wolfe Research with a $154 price target, which would be a 42% upside potential. So there we have 3 stocks all coming in as a 10 out of 10 on the TipRanks Smart Score and a strong buy consensus from the analysts. Now it's time to hear from you guys. Let me know your thoughts in the comments down below. Were you familiar with any of these 3 companies and which catches your eye the most? Make sure to let me know your thoughts. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. It is important that you always do your own research and due diligence before making any investment decision. Now, if you made it all the way to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thank you guys so much for watching, and I'll see you back here next time.